Welcome to Earnings Recap. Today we're covering the Coca-Cola Company's earnings report and earnings call January-March 2025. If you enjoy this kind of content, please like the video and subscribe to the channel. Today we're taking a deep dive into the Coca-Cola Company's first quarter 2025 earnings.
That's right. We've been through the report, listened to the call.
And we're here to sort of break down the key takeaways for you, in plain English, of course.
Exactly. The mission here is pretty straightforward. Get you fully up to speed on how Coke performed in the first 3 months of the year. We'll kick things off with the numbers, the key financials from the earnings report itself.
And then after that, we'll switch over to the earnings call. We'll pull out the questions analysts were asking, and maybe more importantly, what the leadership team said about performance and, their outlook for 2025.
Sounds good.
Okay, let's jump right into those numbers. First part, the financials.
All right. So looking at the big picture for Q1 2025, Coca-Cola's net revenues landed at $11.1 billion. Now, that's actually down 2% compared to this time last year.
Okay, a slight dip on the top line. But when we look at organic revenues, that's often a different story, right?
It is, yeah. Their organic revenues, that's the non-GAAP figure, helps you see the, let's say, underlying performance without currency swings and M&A noise that actually grew by a pretty solid 6%.
6% organic growth. Where did that come from?
Well, mostly from two things. A 5% bump from price mix, so pricing actions and maybe people buying higher priced drinks, and then also a 1% increase in concentrate sales.
Got it. So even with that slight overall revenue dip, the core business grew organically. That price mix piece sounds like they're definitely getting more for their products.
Seems that way. And if we look at actual volume, the number of drinks sold, global unit case volume went up by 2%.
Okay, 2% volume growth. Which markets were strong?
The report highlighted India, China, and Brazil as key drivers for that growth.
Right, important growth regions showing good demand.
Okay, let's shift to profitability. How did they do there? This is where the numbers get quite dramatic, actually. Operating income saw a huge jump, grew by 71%, hitting $3.7 billion.
71%. Wow. What about the adjusted figure, comparable operating income?
That was up too, though not quite as dramatically. Still a healthy 4% increase on a comparable basis.
Okay, still positive. And the operating margin, that percentage of revenue they keep after costs.
Yeah, that's a big improvement too. The reported operating margin was 32.9%. That's way up from 18.9% in Q1 last year.
A huge difference.
It is. And the comparable operating margin also ticked up from 32.4% last year to 33.8% this quarter. Suggests better efficiency for sure.
Definitely a positive trend on the profit side. Okay, let's talk earnings per share, EPS, key metric for investors.
Right. So reported EPS grew 5% to $0.70. And this is but currency exchange rates really hurt them here. Took off about 9 percentage points.
Ouch. So without currency headwinds, it would have been much higher. What about comparable EPS?
Comparable EPS grew just 1% to $0.73. And even that included a 5-point negative hit from currency.
So growth, yes, but the strong dollar is definitely making an impact on those reported numbers. Okay, let's dig into the specific drink categories. Where did that 2% volume growth come from?
Well, sparkling soft drinks, their biggest category was up 2% overall. Within that, you had trademark Coke up 1%.
Okay.
But Coca-Cola, zero sugar.
Yeah.
Still flying. Up 14% growth.
14%. That's consistently strong.
Absolutely. And sparkling flavors grew 2% as well. Really shows that move towards lower sugar options is, still very much happening.
No kidding. What about the other stuff? Juices, water, tea?
Juice, value-added dairy, and plant-based drinks grew just 1%. Then the group of water, sports, coffee, and tea was up 2% combined.
Okay.
But digging into that, water was up a decent 3%, but sports, drinks, and coffee volumes actually declined. Tea was flat.
Interesting mix there. Water up, but sports and coffee down. Okay, let's look regionally. How did the different parts of the world perform on volume?
Europe, Middle East, and Africa, or EMEA, saw 3% volume growth. Solid. Latin America was flat overall. North America actually saw a 3% volume decline.
Down 3% in North America. We'll need to hear what they said about that on the call.
Definitely. Asia Pacific, though, was a bright spot, volume up 6%.
Strong growth there.
And then bottling investments. That was down a big 17% in volume. But they explain that's mostly due to refranchising, selling off bottling operations.
Right. That makes sense with the refranchising strategy. Now, you mentioned price mix earlier was up 5% overall. Was that driven by specific regions?
It seemed pretty broad-based, mostly those pricing actions they took. They did note, interestingly, that the impact from really high inflation markets was actually less this quarter than before. Maybe things are stabilizing a bit or they've adjusted.
Good point. Suggests they're managing that inflation pressure. Okay, cash flow, always critical.
Right. Well, cash used in operations was $5.2 billion in Q1. And free cash flow non-GAAP number showing cash left after investments was actually negative $5.5 billion.
Negative free cash flow. That sounds concerning.
It does. But there's a key reason. They had a massive $6.1 billion payment related to the Fairlife acquisition.
Ah, okay. So if you back that out.
Exactly. If you exclude that one-time Fairlife payment, free cash flow would have been positive $558 million. So that acquisition was the main driver of the negative figure.
Got it. That context is crucial. And finally, before we move to the call, market share. Did they gain ground?
Yes, they reported gaining value share in the total non-alcoholic, ready-to-drink market in RTD, as they call it. So they captured a larger slice of the total consumer spending pie.
Okay, good sign for their competitive position. All right, that covers the key numbers from the report. Let's transition now. Part 2, the earnings call highlights. What were the big themes from management?
A really central theme was what they call their all-weather strategy. Management kept bringing it up, emphasizing how it helps them navigate what's clearly a dynamic, kind of unpredictable global environment right now. Resilience seemed key.
All-weather strategy. Sounds like trying to be prepared for anything the economy throws at them. What else stood out from their commentary?
A huge focus on being consumer and customer-centric, but also doing that with really granular, local execution. They stressed understanding the nuances in each specific market. That came up again and again.
That makes sense given the different regional results we just saw. Okay, let's dive into those regions, starting with North America. Volume was down 3% there. What did they say?
Yeah, they weren't happy with the volume decline, even though revenue and profit actually grew there. They pointed to a few things: bad weather, some calendar shifts, but also, crucially, weakening consumer sentiment. And they specifically called out the Hispanic consumer base as showing some pullback.
Weakening sentiment, especially in a key group. That's definitely something to watch. Were there any bright spots in North America?
Yes, definitely. Coke Zero Sugar, again, strong volume. The Fairlife Dairy business continued to do well. And Topo Chico Sabores, their flavored sparkling water, showed good momentum. They also mentioned winning some food service contracts.
So some positives. What are they doing to fix the overall volume dip?
They said the teams are focused on, quote, impactful investments and making decisions faster to try and get that volume growth back on track.
Right, speed and focus needed there. Okay, Latin America volume was flat. What was the story?
Yeah, flat volume, but they did get organic revenue and operating income growth. Strong performance in Brazil and Argentina helped, but Mexico was weaker.
Why weaker in Mexico?
They said it was partly tough comparisons to a strong prior year, those calendar shifts again, but also diminished consumer sentiment there too. They link that partly to geopolitical tensions in the region.
Geopolitics hitting consumer sentiment seems to be a recurring theme. What are they doing in Mexico specifically?
They mentioned responding quickly, focusing on affordability with value packs, especially in certain channels, and they launched a Hecho in Mexico, Made in Mexico campaign to build local trust.
Okay, affordability and local connection. Seems like a core strategy. How about EMEA, Europe, Middle East, and Africa? That was up 3% volume?
Yes. Growth across the board in EMEA. Volume, organic revenue, and comparable operating income. Within Europe, it was a bit mixed between West and East. Strategy there is affordability and integrated marketing. They mentioned a Coke campaign called Everyday Tasty Celebrations and a fan tax box partnership.
Trying to hit different consumer groups there. What about the rest of EMEA? It's a diverse region.
Very diverse. Eurasia and the Middle East showed strong volume despite issues in Turkey. They felt they navigated Turkey better this year by understanding consumers faster. And Africa saw volume growth even with high inflation, helped by refillable bottles and localized campaigns.
Sounds like the teams there are adapting well. Okay, finally, Asia Pacific, up 6% volume, a strong region.
Yeah, strong overall growth in APAC for volume, revenue, and operating income. But interestingly, ASEAN and South Pacific actually saw declining volume, even while gaining value share.
So people spent more, but bought less volume.
Exactly. So the focus there is affordability, again, refillables, pricing, plus getting more outlets and cold drink coolers in place. China, however, saw positive volume growth, helped by better execution and Lunar New Year marketing.
Good to see China growing.
And India was very strong. Robust growth across the board, adding lots of outlets, more digital customers. Japan and South Korea also grew, particularly with their Ayataka tea brand.
So, mostly positive in APAC, but some areas need work. Beyond regions, what about their overall brand portfolio and innovation pipeline?
They highlighted having $30 billion brands now. Just shows the scale. And also noted that 30% of their global volume is now low or no calorie drinks. That shift continues.
30% is significant. And innovation and marketing.
They talked about their marketing transformation, using something called Studio X for faster tailored digital campaigns. And exciting news for some of them, the Share a Coke campaign is coming back globally in 2025.
Ah, Share a Coke. People remember that one.
For sure. On innovation, the strategy is now fewer but bolder launches, focusing resources. Examples given were Fused Tea expansions. And in the U.S., things like Coca-Cola Orange Cream and Simply Pop, which is their first prebiotic soda.
Fewer, bolder launches. Makes sense. Did they comment on global trade uncertainty?
They did. They stress that they operate locally, mostly, but acknowledge they aren't immune to global trade issues. However, they feel the impact is manageable right now, and they have ways to mitigate challenges.
Okay, keeping an eye on it, not overly concerned yet. Let's talk outlook. Did they update their guidance for the full year 2025?
Yes, they kept the organic revenue growth forecast the same, 5% to 6%. But they actually raised their outlook for comparable currency-neutral EPS growth, now expecting 7% to 9%.
Raised the underlying profit growth outlook. That's positive.
It is, but the flip side is they expect currency headwinds to be worse now. They see a 2-3% negative impact on comparable revenues and a bigger 5-6% hit on comparable EPS from currency.
Ah, so the stronger dollar is biting even harder than they first thought.
Exactly. So when you factor that in, the all-in comparable EPS growth expectation stays the same at 2% to 3%. The underlying business outlook improved, but currency offsets it on the bottom line.
Okay, that's clear. What about the upcoming second quarter? Any specific things to keep in mind?
Yeah, they flagged tougher volume comparisons versus Q2 last year. They also said recovery in some of those weaker markets might take time, and the benefits from their productivity efforts are likely more weighted to the second half of the year.
So maybe temper expectations a bit for Q2 volume, look for more gains later in the year. What about Fairlife? We mentioned the acquisition cost. How's the brand doing?
Still performing strong, they said. But they also guided that the percentage growth rate will likely moderate just because it's becoming a bigger base business. Makes sense. Importantly, they expect significant new production capacity for Fairlife to come online late in 2025.
Good, planning for future growth there. Any other specific focus areas mentioned?
They see more room to improve margins in North America specifically. On China, they sounded positive about momentum there, driven by portfolio work and brand updates.
Okay.
They also elaborated a bit on that Hispanic consumer pullback, suggesting links to geopolitical tensions, especially near border regions. The focus there is local relevance and affordability to win them back.
Interesting connection they're drawing there.
And finally, they noted globally, both at-home and away-from-home channels grew, with away-from-home slightly faster. But a slight warning sign, perhaps. They saw some potential weakness in future consumption trends in developed markets like the U.S. and Europe.
Okay, something to watch in developed markets. So wrapping up, a complex quarter, but it sounds like they feel their strategy is working.
Absolutely. The results in the commentary really highlighted their ability to execute, even with all the global complexities. They seem to be managing through it.
And clearly balancing volume growth, getting the right price and mix, and pushing for those margin improvements. It's a juggling act.
It really is.
Yeah.
And that emphasis on local understanding, local execution, it seems absolutely critical for a company operating in so many different places like Coke does.
Definitely. So thinking about everything we've discussed, the varied regional results, that strong focus on local strategies, it leaves you wondering, doesn't it? What are the biggest future challenges and opportunities for a global giant like Coca-Cola to keep growing consistently? What adaptations will be crucial for them across all these different cultures and economies? Something to chew on.
It certainly is. Well, thanks for joining us for this deep dive into Coca-Cola's first quarter.